I'm going to break down two of Vanguard's most popular ETFs, VOO and VTI. I'm going to tell you the differences between the two in simple terms that everybody can understand. I'm going to show you which one has performed best historically, the difference in the holdings that each fund has, and which one I would own right now as a buy and hold forever investment. Both of these are ways that you can essentially passively invest in American companies. What VOO is that pretty much only invests in America's 500 largest companies. You could see 508 holdings. VTI gives you exposure to those same 500 companies. It owns a lot of the same companies, but it gives you exposure to the rest of the stock market as well. That's medium-sized companies, small-sized companies that you can't get exposure to in VOO. Now, to figure out which one of these strategies is best for you, we need to dive into the details and talk about the differences in the risk and the performance of these two types of investments. Now, again, we are in crazy, scary, recessionary times, and everybody's afraid of investing right now. This is exactly the time that you should be investing and building your nest egg for the future. This is the S&P 500 returns by decade since 1900. 122 years we're talking about. The average decade, the market has been up 198%. The average year has been up 10%. And if you look, there have only been 2 decades where the S&P 500 was negative. That was the 1930s and the 2000s because of the dot-com bust and the great financial crisis. This tells you everything you need to know. If you invested $1,000 in 1900 in an S&P 500 index fund, today it would be worth $103 million. Not a get-rich-quick overnight scheme. It's not a crypto pump and dump. It's not a momentum stock, meme stock strategy. That does not work for the majority of people. If you want to become a true millionaire and be able to enjoy your life and pass generational wealth on to your family and rest easy at night, this is how you invest. 2 minutes covering VOO. Let's go. I'm going to tell you everything about it in the next 2 minutes. The index pulls in stocks of the largest 500 US companies that pass its market cap, liquidity, and profitability screens. Because of those screens, that profitability requirement introduces a slight quality tilt to the portfolio. Most large cap stocks are profitable, so this requirement generally does not have a material impact on the portfolio's composition. The portfolio's top 10 holdings represent about 29% of its total assets. Let's get into performance, and we're going to look at year-to-date, 5-year, and 10-year performance for both of these funds. Year-to-date, the VOO is down 17%. Over the last 5 years, it has averaged 10.5% a year. Remember that S&P 500 does about 10% per year. But over the last 12 years, even with it down right now, it's been averaged 12.8% per year. At the end of this, I'm going to show you what $500 invested, earning 9% a year, turns into over time. And you're going to be amazed at how many millions of dollars that turns into. Okay, when you talk about any investment, you have to talk about risk. Remember, past performance is not an indication of what's going to happen in the future. These are just things that have happened in the past, and this is just for entertainment purposes. The risk is rated as average. The return versus the category is rated as above average. And if you look, the maximum downside that has happened over the past 5 or so years has been minus 23.9%, which is actually, we're in the middle of it right now, or it was from January 1st to September 30th, 2022. It took 9 months. And now let's get to the portfolio, right? And this is where I'm going to show you the difference. So if we look at weight, you can see that pretty much everything's in large cap. 18% is in large cap value, 34% is in large cap blend, 32% is in large cap growth. Medium cap is 5, 9, and 2%, and then 0% in small cap, okay? Remember that 0%, when we get to VTI, that's gonna be the difference. We can see the average price to earnings ratio is 15, does have a 1.98% dividend yield, and then basically you're gonna see they get a B plus for financial health, B minus for profitability, and B minus for growth. So now we're gonna cover the top 20 positions in each of these funds. Apple, Microsoft, Amazon, Tesla, Alphabet, Berkshire, United Health, Johnson & Johnson, ExxonMobil, Meta, JP Morgan, Nvidia, Procter & Gamble, Visa, The Home Depot, Chevron, Eli Lilly, Pfizer, MasterCard. That's VOO. You could feel completely great about owning VOO and never having to look at it and never having to touch it and just adding to it every single month. VTI, this is the one that gives you exposure to the more companies in America, the smaller cap companies. I'm going to tell you which one of these I like the best at the end, so stick around. And here's the thing, it does own small cap stocks, but it has to pass the CRSP investability screens. The criteria ensure smaller stocks in the index are easily traded, so you don't have any like volume or major risk issues that way. They include a minimum market cap requirement of 15 million and a minimum float to total shares outstanding ratio of 12.5%. And this is the big difference. So it does tilt towards the larger market cap companies. We're still going to see that's most of the portfolio, but during periods where smaller stocks outperform, it can benefit from its small cap exposure, which sat at 8.6% as of January 22. So let's remember that. Small cap stocks have struggled recently, which this goes into why one of these is going to be my favorite over the other right now. Do you have an idea of what it is? Drop it down in the comments and let me know, and we'll see if you get it right at the end. All right, let's look at performance. Year to date, minus 18%. 5-year, 9.89%. 10-year, 12.49%. Okay, and so each of these is a little bit worse than VOO, okay? So VOO has outperformed year to date, 5 years and 10 years, all right? Let's go to risk. Maximum drawdown, 24.87%. That's also about 1% worse than VOO, okay? Now let's look. This is a great depiction of the difference. You have the large cap value at 15%, blend at 29, growth at 29. Medium's about the same as VOO, but here you go. Small cap, 3, 4, and 2%. So for a total of about 9% in small cap stocks. You don't get any of that exposure in VOO. Now here's the thing. Price to earnings is actually a little bit lower than VOO, okay? This is where I think some of the opportunity for the future starts to come from. And you may be starting to figure out which one's going to be my favorite. I'll tell you for sure at the end. And then let's jump over to the top 20. Apple, Microsoft, Amazon, Tesla, Alphabet, United, Berkshire, Johnson & Johnson, ExxonMobil, pretty much the exact same. Meta, JP Morgan, Procter & Gamble, Visa, Nvidia, the Home Depot, Eli Lilly, Chevron, Pfizer, and MasterCard. And so you still get exposure to all those same great companies. The position sizes are just a little bit smaller, which gives it some of that room to own some of those smaller market cap stocks. And here we go real quick, the small cap versus large cap. And the answer for me is going to be VTI, which one I want to own, which one I think is better to own right now, buy and hold forever. We could see that during bear markets, the small cap stock, this is the Russell 2000, smaller cap versus the S&P 500, underperforms, down 23% versus 12%. This is just one example. But then this was in the market after the 2008-2009 financial crisis. Look how much small cap stocks outperformed large cap stocks by. It was 95% to 68%. And so I think right now we're at the period where small caps have underperformed. They've been hit harder, hit worse. And so if I'm buying one of these funds right now to buy and hold forever, they're both fantastic. But for me, my risk profile, my preferences is going to be VTI over VOO because I want that small cap exposure and I'm okay with that volatility. Let's build a scenario and see how much a realistic amount of money invested every month can turn into over a 40-year period investing. We're starting with zero, $500 a month. And if you look, then over 40 years at 8%, that money turns into $1.5 million. If you earn 9%, remember the market has done 10% on average, but we're being a little bit more conservative here. If you earn 9%, that's over $2 million. And if it earns 7%, a little bit less, $1.2 million. Let me know in the comment what funds you want me to review next, and I will give you an honest review right here on this channel.